Last week, markets actually rallied 1%, but it just didn't feel like it because we had so much chop and volatility. But I think overall it was actually a win because on Friday, Fed Chair's Jackson Powell's speech, I think leaned quite constructively towards our view because even though he was, let's say, speaking of being data dependent, it really plays into our view that the trajectory of incoming data is going to be quite soft, both on inflation and jobs, and that's going to allow the Fed to recalibrate their view and ultimately lead to fewer hikes. In fact, we still have our base case being that the most likely path is the July hikes of this year were the last hikes of the cycle. So we don't expect any hikes in September or November. You might be wondering, if the Fed's data dependent, why are people so hawkish? And it's going to depend on the path of inflation, which we think is going to be soft in the next 2 months, 3 months, maybe even the next 4 months, and the trajectory of the labor market. But again, I think there's many growing signs that the labor market is softening. But I think the reason markets are staying hawkish is that most economists and investors are hawks. And I think that they look at whatever the Fed's saying and extracting and hawkish every time they see something. So to me, that's the market bias that should be declining over time, and that's opportunity for equity investors. Stocks are struggling, not surprisingly. Again, we've warned you about August, and August has already been a tough month. At the start of the month, there was a failure. The S&P fell below the 20-day, which is a bad sign. Then on the 15th, it fell below the 50-day, which is another bad sign. And then it broke the trend line on the 16th, which is another bad sign. And now we're up against a key level, which I'm highlighting here. Last week, the S&P failed at the 50-day. That's something that does kind of worry us, and that's why August is proving to be tough. And again, the key level here is 44.60 because that's the intersection now of the 20 and the 50-day. I think it's possible it could happen this week that we could rally up if the data comes in as soft as we expect. In the years where the markets were negative into Jackson Hole, they tended to rally in the following week, 86% of the time, so 6 out of 7 times. So I'm kind of in the camp leaning towards stocks finishing better post Jackson Hole.